Japan has started to crumble, and it may bring down the whole world's economy with it. For nearly half a century, Japan was the world's piggy bank. It pumped trillions into global markets, everything from buying US Treasury bills, funding airports in India, metro lines in Australia, you name it. Its pension funds grew so massively that they became the single biggest foreign owners of everything, from European bonds to Silicon Valley tech stocks. At its peak, Japan's net foreign assets topped at $3 trillion, more than any other country on Earth. Whenever Wall Street or Frankfurt needs liquidity, Tokyo was there with an open wallet. But now, that piggy bank is running empty. In fact, the tables have turned. Japan's debt to GDP now sits at roughly 260%. That means Japan owes roughly 2.5 times more than the total size of its entire economy. For comparison, the United States, which is often criticized for having huge debts, has a debt to GDP ratio of around 125%. Even Japan's own prime minister has openly admitted that their financial situation is worse than Greece's. Greece faced several debt crises around a decade ago that nearly caused Europe's entire economy to collapse. At the very worst point in that crisis, Greece's debt to GDP ratio peaked at around 190%. You see, for any economy, even giants like the US or China, there are a few critical factors that ultimately decide its fate. First, it's demographics, basically how a country's population has grown or changed over the past few decades, and how it'll evolve in the coming ones. Like China, whose workforce peaked back in 2011, compared to the US, which still sees growth thanks to immigration. Then there's debt. But it's not just about how much a country owes. It's more about whether it can manage that debt without choking its own growth, and its capacity to service it. Finally, it boils down to productivity, innovation, and institutions. These decide if an economy can effectively turn resources into real growth, and whether it can maintain solid access to global markets. In the end, all these factors work hand in hand to keep things running smoothly. But the moment one starts to slow down or fails, it gradually pulls down everything else, bit by bit, until the entire economy starts falling apart. And that's exactly what's happening to Japan. In 2024, just 720,988 babies were born in Japan. To put that number into perspective, over 1.62 million Japanese people died that same year, meaning for every baby born, more than 2 people passed away. And this is Japan's biggest challenge, because the country's population has been declining steadily for the past 9 years straight. Japan is literally running out of people, particularly young people. Japan's population peaked at around 128 million back in 2010, and it has been shrinking ever since, dropping to roughly 123 million by 2025. And if this wasn't already a problem, Japan also has one of the highest life expectancies worldwide, nearly 85 years old on average. Living longer might sound great, and it is mostly, but from an economic perspective, it brings serious problems. Fewer young people means a shrinking workforce, weaker domestic demand, and lower tax revenues. At the same time, pension and healthcare costs for the elderly keep skyrocketing. You see the cycle, right? The government has tried various measures like financial incentives for families to have more kids, better childcare support, and even slightly relaxing Japan's traditionally strict immigration policies, making it a bit easier for foreign workers to come and help fill the gap. But there's only so much these measures can achieve. Cultural and structural factors like high cost of living, small housing spaces, delayed marriages, and more women pursuing full-time careers mean birth rates remain ultra low. Currently, it's hovering at around 1.2 children per woman, way below the roughly 2.1 needed just to keep the population stable. If nothing changes, by 2050, Japan's population will fall below 105 million, and possibly even 87 million by 2060. In simple terms, without dramatic actions, year after year, the tax base shrinks, public spending grows, and Japan gradually loses its ability to manage its debts. For years, Japan's finance ministry has warned that the national pension and the healthcare systems face severe strain as the worker-to-retiree ratio keeps dropping. Today, that ratio stands at just 1.8 workers per retiree. Back in the 1990s, it was a comfortable 5.1 workers per retiree, meaning plenty of people were working and contributing taxes to comfortably support the elderly. But now, with far fewer workers available, each individual must shoulder a significantly heavier burden. A greater portion of their income goes directly into taxes, pensions, and healthcare for the elderly, leaving very little for personal savings, investments, or their own retirement plans. As younger generations find themselves stretched thinner and thinner, the economy itself slows down because there's simply less money circulating, trapping Japan in a loop of endless budget shortfalls and growing debt. And that brings us to our next chapter. Like we mentioned earlier, Japan's debt is roughly 2.5 times larger than its entire economy, by far the highest among all major economies in the world. And that's why we're calling it Japan's Mount Fuji of debt. But how on earth did Tokyo let numbers climb this high? Let me take you back to the 1980s. Back then, Japan was booming. Real estate prices soared, stock markets hit record highs, and everyone thought the good times would never end. But suddenly, in the early 1990s, Japan's economic bubble finally burst.
The Japanese economy depends heavily on exports. About half of those exports are sold in America. And when Americans stop buying Japanese products, they feel it here.
The fear here is that if the world's biggest economy goes down, it'll take the world's second biggest economy down with it.
Before Japan began a long slide into deep recession. But it's the young Japanese who were just children when the bubble burst who are still paying the price today.
Stock markets crashed, and real estate prices, which had soared so high that the land around Tokyo's Imperial Palace alone was said to be worth more than all the real estate in California, came crashing down. This collapse pushed Japan into a painful, prolonged era of stagnation and deflation, now famously known as the Lost Decades. To stop a freefall, Tokyo did the only thing politicians everywhere know how to do: spend money. New highways, bridges, subsidies, make work projects, you name it. The strategy worked just enough to keep the lights on, even though tax revenues barely budged in the sluggish economy. Soon, this became a habit. Every time economic growth slowed down, the government responded with even more stimulus. By the late 1990s and throughout the 2000s, Japan's budget deficits had become a new normal. Even in relatively good economic years, they rarely balanced their books. And during emergencies like the 2008 global financial crisis, the devastating 2011 earthquake and Fukushima disaster, or the COVID-19 pandemic, Japan spent huge amounts to keep the economy afloat. They piled debt upon debt, hoping they'd somehow fix things later. It's similar to paying off one credit card bill with another credit card. Yeah, you can keep going, but only if someone keeps lending to you at pretty low rates, and a large part of their savings ended up invested in Japanese government bonds, either through banks or the country's popular postal savings system. Since inflation was basically zero, people didn't mind earning tiny returns on these bonds, because everything else was giving very low returns anyway. Also, since Japanese citizens held most of this debt themselves, Japan didn't need to worry too much about foreign investors suddenly pulling their money out and crashing the economy, something that caused chaos for countries like Greece. Because of this unique setup, Japan managed to carry this enormous debt for decades without facing any big crisis. Interest rates on these government bonds slowly kept falling over the years, eventually reaching almost zero. More on that soon. But just because investors accepted this debt doesn't mean it wasn't dangerous. Japan's government now owes roughly 1.1 quadrillion yen, around 8 to 9 trillion US dollars. Paying the interest on this debt, called debt servicing, is a huge expense. As of 2024, about 24% of Japan's annual budget went to national debt repayment. That's 27 trillion yen. To make it worse, Japan's finance ministry has repeatedly warned that if interest rates rise even slightly, debt payments could explode. That would force Japan to borrow even more to cover its growing interest costs. This is known as a debt spiral, a dangerous loop where rising interest rates lead to higher debt payments, which widen the deficit. To cover the gap, the government borrows more, spooking investors and pushing interest rates even higher, and the cycle keeps feeding itself. Japan has avoided this spiral mainly because interest rates stayed extremely low, and because of one key player: the Bank of Japan, or the BOJ. Over the past decades, the Bank of Japan implemented a financial strategy called quantitative easing, or QE. Basically, QE means the central bank creates new money electronically and uses this fresh money to buy government bonds. By 2024, the BOJ held over 570 trillion yen in Japanese government bonds, or JGBs, accounting for more than 50% of all outstanding government debt. This effectively meant the government owed a massive portion of its debt to its own central bank. The goal was to suppress interest rates by increasing demand for bonds, keeping yields near zero or even negative. This allowed the government to borrow cheaply even when total debt was at 260% of GDP. To put this into perspective, the Bank of Japan's bond-buying spree made even the US Federal Reserve's QE look tame. At one point, the BOJ's total holdings reached over 130% of Japan's GDP. Now, this arrangement worked surprisingly well for many years. Japan's government could keep borrowing and spending without facing backlash from financial markets. Domestic investors and the Bank of Japan guaranteed that someone would always buy their bonds, allowing Japan to keep their interest rates ultra low. But this equilibrium was always a bit fragile. It depended entirely on ultra low inflation, extremely low interest rates, and a constant willingness to keep buying bonds. Similar to a pressure cooker, there's a small valve letting the steam escape slowly, keeping the pressure manageable. But if that valve were to close or malfunction, you'd get a blast of pressure. You see, before the lost decades of the 1990s, Japan used to have an interest rate of around 6% by 1995. It was cut to 0.5%, and yet the economy stayed weak. Prices kept falling, companies held back, and banks were full of bad loans from the bubble era. People didn't want to borrow or spend. Moreover, the 1997 Asian financial crisis hit Japan hard. Growth slowed further, consumer confidence fell. The government tried stimulus packages, but debt kept rising, and nothing really fixed the problem. So, in 1999, the BOJ formally adopted a zero interest rate policy, and for the next 2 decades, Japan never really moved away from that 0% mark. To an extent, this policy helped stop things from getting worse, but it didn't fix the deeper problems. So in 2016, Japan went a step further. The BOJ adopted a negative interest rate policy, meaning banks had to pay a small fee to store excess money with the central bank. Japan had one goal in mind: to encourage banks to lend more money and persuade people and businesses to spend instead of saving. At the same time, with quantitative easing, the Bank of Japan kept printing more money and began paying huge amounts of government bonds, stocks via ETFs, and even corporate debts, anything to pump liquidity into the market. But even after all of that, inflation stayed stubbornly low. So, in 2016, the Bank of Japan tried something new. It didn't just cut short-term rates, it started controlling long-term ones too. This was called the yield curve control. It meant that even 10-year government bond rates would stay near zero. And if they started to rise, the BOJ would step in and buy bonds to push them back down. This was like a dream come true for borrowers. People, businesses, and the government could now borrow money almost for free, even for 10 years. This was the moment the yen began flowing around the globe. The reason even a tiny change in Japan ripples through the entire world economy. Economists call it the yen carry trade. You see, when interest rates in a country are extremely low, like in Japan, it becomes attractive to borrow money in that currency and invest it somewhere else with higher rates. Investors and traders around the world saw an easy opportunity. Borrow yen cheaply, exchange them for dollars, euros, or emerging market currencies, then invest in higher-yielding assets abroad, like US bonds paying 3%, Australian bonds paying 4%, or Brazilian bonds yielding even more. The difference between those higher yields abroad and Japan's almost zero borrowing cost became pure profit, as long as exchange rates remained stable. Over the decades, trillions of yen flowed out from Japan. Investors, from Wall Street hedge funds to huge Japanese financial institutions themselves, borrowed yen cheaply and then lent or invested it worldwide. Japan effectively supplied the entire world economy with easy money. This massive outflow of yen kept the currency weak. A weaker yen was actually beneficial to Japan's export-driven economy, so Japanese policymakers tolerated or even welcomed this phenomenon. However, this lucrative carry trade comes with risks as well. The biggest risk was all the sudden currency reversals, especially if the yen strengthened. Let's say you borrow 1 billion yen at an exchange rate of 100 yen per dollar, meaning you'd borrow around 10 million USD. If the yen suddenly strengthened to 90 yen per dollar, that same 1 billion yen you owe now costs 11.1 million USD to repay. You could lose profits, or worse, a massive loss on the capital itself. If the yen suddenly strengthens, even slightly, many traders would rush to repay their yen loans. But repaying these loans means buying yen, which further pushes up its value, creating a vicious cycle. This sudden spike can rapidly wipe out investors' entire capital. For instance, during the 2008 financial crisis, panicked investors quickly repaid their yen loans, causing the yen to surge dramatically. Similarly, in early 2016, even a brief market wobble in the US triggered rapid yen appreciation as carry traders rushed to exit their positions. Analysts describe yen carry trading as picking up pennies in front of a steamroller. You earn a small, steady profit as long as the yen stays weak or stable, but there's always a looming risk of catastrophic loss if the yen suddenly rises. Despite this risk, Japan's predictable, ultra-low interest policies kept volatility minimal for decades, making carry trading seem reliably profitable. Some analysts estimated that by the early 2020s, global investors had built positions worth hundreds of of billions of dollars based on this seemingly safe bet. But by the early 2020s, things started to change. After decades of desperately fighting deflation, Japan finally saw inflation begin to pick up. This rise was triggered partially by increased global commodity prices, partially by historically weak yen, which made importing goods more expensive, and crucially, by rising wages across Japan. In fact, spring 2024 saw the highest Japanese wage hikes in 33 years, finally pushing inflation above the BOJ's 2% target. Now, for the first time in decades, the Bank of Japan was forced to reconsider its decades-long era of ultra-low interest rates. Under the new governor, Kazuo Ueda, who took over in 2023, the BOJ began cautiously shifting towards normalizing policy, that is, raising rates from negative/0 and letting bond yields rise a bit. But like I explained earlier, even a tiny change could have drastic results for investors. The entire foundation of the global yen carry trade started to tremble, and with it, global markets everywhere. Rumors spread fast, and in July of 2024, the BOJ finally nudged interest rates to 0.25%. Investors panicked and rushed to unwind their massive yen carry trades. Roughly half of these carry trades collapsed almost instantly. Global stocks plunged sharply as investors scrambled desperately to repay their yen debts, accelerating the yen's rise even further. Even Japan's main stock market, the Nikkei index, suffered its worst single-day plunge since 1987. Yield curve control was scrapped, allowing Japan's 10-year bond yield to rise towards 1%. Soon after, longer-term bond yields surged dramatically. By early 2025, Japan's 30-year yield reached above 3%, the highest in decades. At this point, Japanese money that had flowed overseas began rushing back home. By late 2023, Japanese investors held a stunning $2.3 trillion in foreign bonds, including around $1.1 trillion in U.S. Treasuries alone, comfortably making Japan the largest foreign creditor to the United States. This huge investment overseas made perfect sense when Japan's interest rates were near zero. After all, why settle for a Japanese 10-year bond at nearly 0% when you could earn 2 to 3% on U.S. Treasuries? But as Japan's bond yields rose, foreign holdings suddenly seemed less appealing to Japanese investors. This created what's known as reparation risk, the possibility that Japanese institutions would still pull money back home, selling off foreign bonds or at least slowing new purchases overseas. As Japanese yields rise, domestic bonds become attractive again. Plus, with a stronger yen, holding foreign investment becomes riskier. By 2023, hedging U.S. Treasury bonds back into yen often wiped out nearly all yield benefits, sometimes making foreign investments effectively negative. This matters a lot globally, especially in the huge U.S. Treasury market, the world's benchmark bond market. YouTube just dropped a mind-boggling announcement. It is paying creators $64 million per day. Why? Well, because YouTube doesn't have enough creators. That is why you see videos on your homepage that have less than 1,000 views, like this one. Now, of course, that doesn't mean everyone should start a channel, but if you have ever wondered about starting a YouTube channel, or a faceless YouTube channel like this one, well, now's the perfect time. YouTube is paying creators millions every day, and it's pushing newer, smaller channels now more than ever. But I'm sure many of you have questions on how to get started and how to grow a channel. We get questions in our email all the time from some of you guys. So that's why we've decided to put all of our YouTube advice into one training bootcamp for the low price of completely free. So, if you're someone interested in starting your own YouTube channel, you can sign up for this bootcamp by clicking on the link in the description or on the screen. Sign up now because, unfortunately, unlike YouTube videos, the bootcamp is like a Zoom call, so it's limited to just 100 people. Okay, let's get back to the video. Japan alone holds roughly 17 to 18% of all foreign-held U.S. debt. Even a small reduction in their holdings or just a slowdown in new purchases could push U.S. interest rates even higher. Prices would drop if more bonds flood the market, forcing yields upward. There's an old saying, if Japan sneezes, the world catches a cold. Usually that's an exaggeration, but in the bond market, it actually holds some truth. Japan's bond market was always stable, almost boring, with steady demand and low rates. But this year has changed everything. Even Japan's own bond market is showing signs of trouble. Sure, it's not collapsing overnight, but for a country that's effortlessly raising funds for decades, this sudden instability is a huge red flag. Just the fact that we're now talking about Japan having bond market scares is entirely new and worth paying close attention to. Still, at least for now, and probably even through the next decade, Japan won't collapse. The truth is, when Japan's own prime minister openly says the country's finances are worse than Greece's, people understandably get nervous. Greece, after all, endured a devastating debt crisis in the 2010s, borrowing costs exploded, banks needed bailouts, and brutal spending cuts caused real and deep economic suffering. But Japan is different, very different from Greece. First, Japan borrows its own currency. It has its own central bank, the Bank of Japan, which can always print more yen if necessary. Greece couldn't do this because it relied on the euro, a currency it didn't control. Japan, unlike Greece, can never literally run out of money or be forced into default. Second, almost all of Japan's debt, around 90 to 95%, is owned domestically by Japanese banks, insurers, pension funds, and especially the Bank of Japan itself. Greece's debt crisis exploded because it owed a lot of money to foreign investors, who panicked and quickly withdrew funding. Japanese investors are stable and less likely to suddenly abandon their own government bonds because doing so would also harm themselves. Third, Japan's financial situation is transparent. Everyone knows exactly how big its debt is. Greece's crisis worsened when hidden deficits suddenly surfaced, destroying trust. Japan's issues, though severe, are well understood by investors who've already priced them into their expectations. Fourth, Japan's economy and financial market are huge and diversified. It's the third largest economy globally and the second largest bond market. Greece's economy was tiny in comparison and unable to absorb the crisis. Japan, in contrast, still generates consistent trade surpluses and has globally competitive industries. Lastly, Japan needs no external bailout. No IMF or European Union loans can force stupid rules like spending cuts. Japan finances itself. These critical differences mean Japan likely won't face a sudden Greek-style collapse or outright default. Instead, Japan's bigger risk is more gradual, a slow erosion through inflation, currency devaluation, or monetizing debt, where the Bank of Japan continuously rolls debt over indefinitely, thus reducing the yen's value and weakening purchasing power over time. Still, Murphy's Law reminds us that anything that can go wrong eventually will. And given Japan's global significance, even this slow crisis is extremely dangerous to everyone. Japan represents about 6% of the entire global economy, with its financial tentacles everywhere, from massive holdings of US treasuries to global stock and bond markets. If Japan seriously falls, then it could trigger a global meltdown. Every nation would see fire sales happen. Several markets would collapse. A crisis in Japan won't be contained in the way Greece's was. To say the least, Japan is too big to fail.